Welcome back, ladies and gentlemen. You're watching Startup Central, and let's now put the spotlight on Tracxn, which has come out with a report in this time. This is around India's D2C annual funding trends. The year 2025 so far has seen $219 million funding in the D2C space, and that's across 81 rounds. Last year, this figure stood at over $700 million across 276 rounds. 2025 has also seen 17 new investors emerge in this space. In fact, Bengaluru has emerged as the top funded cities. No surprises. And then it's followed by Gurugram and Mumbai. And online jewelry brands, it seems, are taking the spotlight as far as top funded business models are concerned. To decode all that's happening in the Indian D2C space, joining us now is Neha Singh, the co-founder of Tracxn. Neha, thank you very much for taking the time out. Lots of interesting trends that are being seen in the D2C space. Take us through the key highlights of this report.
Thanks a lot for having me. So we recently released a report on the D2C brands because this is becoming a very prominent sector for investors, both venture capital investors as well as private equity investors. So if you see across the last 5 years, over $5 billion have been invested in the D2C space in India across over 1,000 plus transactions. And even if you look at last year, nearly 800 million was invested, and this year, in the first 4 months, more than 200 million has been invested, across the D2C sector, in India. And, one of the things which has happened is that D2C has become a very prominent sector in investor interest, in addition to some of the other sectors. So if you ask most of the investors, what are the top areas that they are looking at? So in addition to the usual suspects that you have, which is, AI and quick commerce, right now you hear a lot more about D2C brands also coming in the top 3 sectors for a lot of investors. And this includes investors, across the early stage as well as the late stage, right? So I think that is something very interesting. One of the reasons probably of that is that, D2C brands today are able to scale much faster than what they were probably 5 years back. Right, so there is this golden revenue threshold that is considered among the D2C brands, which is reaching 100 crore in revenue. So earlier, for instance, it would take quite a few years for companies to reach that milestone, and today they are able to reach that milestone much faster within 2 to 3 years for a lot of companies. Because of a lot of factors. Obviously there is the macro factor, which is the India's rise in GDP. So there is much more demand for premium as well as niche products, which is there. In addition to that, you now have much deeper penetration of digital platforms, be it
Right.
online e-commerce platforms like an Amazon or a Flipkart,
Absolutely.
as well as quick commerce today, which is also becoming a prominent channel for a lot of brands. So they are able to reach the masses, across tier 1,
Absolutely.
tier 2, tier 3 cities much faster than what they were able to do that much earlier. And as well as I think the targeting has become much better. So they are able to reach out
Neha,
to the relevant customer segment.
Yes, absolutely.
Yeah.
Neha, that's absolutely right. I mean, the way you put it, that it is the digital expansion of platforms that's essentially led to an improved reach for some of these brands as well. There's personalized targeting as well on the D2C front. But let me talk about investments once again, and let's go back to that point now. While early stage investments are increasing, it seems that late stage funding has seen a substantial decline. What do you think are the challenges that mature D2C brands are facing that might be contributing to this trend?
Right. So you did see some drop, across the late stage, but that I would say is in line with the overall funding slowdown that you are seeing across sectors as well. So not just D2C, but across all the other sectors as well. And in fact, if you look at the share of D2C in terms of the overall funding, so that has gone up. So earlier it used to be between 3 to 5%. In the recent years, it has also reached as high as 8%. Right. So I think in the overall pie, it has increased, though there is impact which is there because, of the overall slowdown which the sector has seen, especially the late stage.
Right. Overall slowdown is something that you're attributing to, but let's talk about investor interest. I mean, given the cautious investment climate, how are investors adjusting the strategies in the D2C segment? You said that, an impact is being felt in the late stage, but are there any more trends that you are looking at, that you're observing with respect to this funding trend and, of course, the uncertainties that there are across, the global economy in the global sphere?
Yes, that is correct. So, in terms of the investor outlook, I think a couple of things have changed in the recent years. So, one is just the focus on profitability, and that you see as a narrative from the investors, that they are looking at brands, who are either profitable or have a path to profitability. And you also hear that from founders, more so, that they are also looking to become profitable. So that's one, key overarching that you see, across the D2C brands. And the second is also, just the exitability. So if you see the D2C brand as a space is very amenable to exits, either through an M&A or an IPO. And interestingly, that has also seen an uptick. So if you look at the acquisition trend, in the last 5 years, there are more than 80 acquisitions that have happened, and that trend has been actually increasing. So it's very healthy for the ecosystem. This year, for instance, you saw the standout transaction, which was Minimalist being acquired by HUL for more than $300 million. So that was a high amount in terms of the acquisitions that the space has seen. And also coming to the other aspect, which is the IPO. So it is also seeing a robust IPO pipeline from the D2C brands. So if you see across the last 5 years, there are more than 14 companies that have become public in this space, including the venture-backed companies like a Mama Earth or Go Colors, right? And in addition to that, you also see a pipeline of other companies who are looking to go IPO, which includes companies like a Bluestone or a Lenskart or a Boat. So I think that is one thing that you also see, across investors. One is the focus on profitability and the talk about companies, like going public, or at least preparing for going public.
Right. And one final question before we let you go. Of course, you've presented the holistic picture so far as funding till now in the D2C segment is concerned. Later stage startups, well, there seems to be some caution. IPO pipeline is good. Of course, early stage is seeing robust activity. But what do you foresee for the Indian D2C landscape over the next couple of months?
So we continue to be very excited about the D2C space overall. A couple of the factors is that, now, as I was mentioning, brands are able to scale much faster. India is anyways a brand starved country, so there is need for a lot more brands to actually come in. And you're also seeing brands sort of scaling much faster, and that is why you also see this continued investor interest. And there are a lot of new investors which are also making investments in the D2C space in the last couple of years. So that continues to be a very healthy trend, and we remain very bullish on this sector going forward as well.
All right, Neha, thank you very much on that note for giving us a snapshot of where things stand so far as the D2C segment is concerned. Appreciate you taking the time out and speaking to us here on ET Now.